Hi, I'm Sidney McKinnon, MD and CIO of Cadiz Asset Management, and once again, welcome to one in the series of all things fixed income. Today, I'll be talking to you about the risks and rewards or benefits that you can achieve by investing in the fixed income investment and environment. And to start off with, let's first have a look at what the risk is. And I think I may have mentioned this in one of my videos before, but if you look at risk, the dictionary definition of risk says that it is exposure to the possibility of loss, injury, or other adverse or unwelcome circumstance. So we sit and think about that for a second. The probability of loss. And I think that's probably the important part of the definition when we talk about risk. And it does not matter what investment you are making. If the probability of loss exceeds what you can bear or expect or would want to have, then you have to look at your risk components very, very carefully. Now, the fixed income market has certain risks associated with it, like any investment. And I'll take you through a few of the basic risks that are associated with fixed income, in particular bond investing. And hopefully at the end of this, you'll have a better understanding as to how this affects your risk tolerance when investing within the fixed income environment. So the first one I want to talk about, and that's quite important because it's basically one of the major risks in fixed income, and that is interest rate risk. Now, we all know, or we should know, that fixed income investments or bond investing or investing in this income environment is heavily influenced by the directional movement of interest rates. If interest rates are going to move one way or the other, that's down or up, I suppose that's the only way they can move, or remain stable for a while, it will affect the value of your investment. If you are investing, for example, in bonds and interest rates are declining, it will increase the capital gain of your investment. Great. If interest rates rise, it will decrease the value of the capital value of your investment. The important thing is the rate at which this increase or decrease happens. Do you have the ability to withstand the fluctuations in interest rates when investing in the interest rate market? Having said that, though, it can be quite severe at times, but most of the time it can be classified as one of your less riskier investments when looking at the bigger scheme of things and investing in you. There are more riskier investments out there. But the important thing is you have to be able to understand and also be able to weather the storm when there is fluctuations in interest rates. So that's the first risk involved when investing in fixed income instruments. Obviously, if interest rates are declining and you are an investor and you are invested in the bond market, great. But if you are investing in fixed deposits or the short end of the fixed income curve, you will then be receiving a less interest for your investment. Also, that kind of risk you have to be able to tolerate and take into account. Now, the next one I want to talk about is liquidity, which I suppose is a risk that's associated with most investments. How easy is it for me to get my money back or to liquidate my investment, to sell my investment? Generally, in the fixed income environment, it's fairly easy unless you invest in instruments such as fixed deposits that are locked in for a particular term, and then you have to wait for that term to finish, or generally you might even have to pay a penalty for getting out of it. But generally, the fixed income environment, especially your money market and your bond environment, is very, very liquid. So the liquidity risk associated with fixed income investments is fairly low. Now, I know fairly low is a relative term, but there are much more illiquid investments out there that you may not be able to sell very quickly should you need your money. There's two more basic ones that I want to mention. The first one is your credit risk associated with fixed income investments, because fixed income investments are issued largely, or let's not say largely, but by a variety of issuers. A large issue into the fixed income environment is government. So if you're buying government-related investments, you can generally consider them as safe as the government. But then there are other corporate institutions that also issue, like your banks, and the big banks within this country generally also issue investments, or you could walk into a bank and invest with their fixed deposits or certificates or whatever the case may be. But then there are also corporates that will issue in the markets, and these corporates may not be as liquid, or alternatively the corporate might have its business and its business model might not be as safe as you think it is. So that's effectively the credit risk. So you don't want to put your money into something that potentially could lose its value very rapidly, because the business model that is being applied by the corporate that issues this investment is not sound or safe enough. The last one I want to mention is probably more related to an economic fundamental, and that is inflation. Quite a hot topic, often of the time, and largely in fixed income investments, your rate that is quoted you, or the yield that is normally quoted you, has embedded in it a certain amount of inflation protection. In other words, the yield is supposed to compensate you at least for inflation. So if you are getting a yield that's below inflation, you are running the risk of inflation at whatever level it is, high or low, eroding the value of your investment. So let's say, for example, you take out a fixed income investment that gives you 10%. I'm making up these numbers. Inflation is running at 5%. You are effectively doing better than inflation, which means your future value of your money will actually grow without being eroded by the effects of inflation. Conversely, if you take out a fixed income investment that pays out 5%, but inflation is running at 7 or 8%, effectively you're going backwards because your investment is being eroded by the effects of inflation. Now, I think that's quite important. So from a risk perspective, I've only mentioned 4. There's a myriad of other risks that are associated with fixed income investments that have little nuances that can actually change the course of the way in which your investment goes. But those are the 4 main ones: your interest rate risk, your credit risk, your liquidity risk, and of course inflation. On the other side of the coin, there's obviously, by investing, doesn't matter what you invest in, there should be rewards or benefits for investing in that particular asset class. So why invest in the fixed income market, or why invest in the bond market? Surely, by taking that risk and taking into account the risks that I mentioned early on, you want to have some reward, or you want some benefit. At the end of the day, whenever that day is, you want to be able to say, well, where's my reward? Once again, if I go to the dictionary says a reward is something given in exchange for good behavior or good work. That's the dictionary definition of a reward. But I think if we want to apply it to the investment sense, effectively what it means is what benefit you're going to be getting out of your investment for its good performance, for want of a better word. All right? So what can you expect by being invested in the fixed income environment? First of all, as I mentioned earlier on, you can get capital gain. In other words, your money can grow if interest rates move in the direction that is suited to that fixed income investment. Generally speaking, it can actually grow at an exponential rate. In other words, for the mathematicians amongst us, it generally can grow more than the linear rate, or in a straight line, it could grow at an exponential rate. So that's a big reward, which gives you the effect of compounding. It gives you the ability to participate in an investment that can grow exponentially. In other words, quicker, and the rate can actually increase as you go along. Then, of course, the big benefit of investing in the fixed income environment is diversification. You then have an asset class that you're invested in that is not necessarily correlated to any other asset classes, which gives you that diversification, a huge benefit for investing in anything. And then, of course, as I mentioned, as inflation is a risk, it is also a benefit in the sense that most of your fixed income investments, if you choose carefully, has inflation protection built into it, provided you stay the course and you invest for the time horizon that is stipulated in order to receive that benefit. So quite a good benefit to have inflation protection. Largely, your fixed income investments, and as an added benefit, are more stable and predictable than other asset classes because generally they pay you interest or coupons on a regular basis, and you know what that is going to be generally. So if you have predictability in any investment, it's always a good thing because you can then plan and you would know what you're going to be receiving in the future as opposed to not knowing what your future payments or interest payments are going to be. So putting all of these things together, most certainly investing in the fixed income environment has got its risks, but it also has its benefits or rewards or advantages. Hopefully this session has shed some light on the risk and rewards associated with fixed income investments. This is Sidney McKinnon. Until next time, thank you.